Now with my guest, Patrick Barbe, Chief Investment Officer of Core Fixed Income at BNP Paribas, we will discuss the outlook for bond yields and interest rates. Patrick, will it be likely that interest rates and bond yields will be dragged down further into negative territory with possibly a massive distortion of global asset prices?
Yes, as you understand, the market trends are clear. The yields are going down because of the demand in bonds. If you just look at the Eurozone as a whole, we have still inflows in the Eurozone. What we call surplus, economic surplus, is important for the Eurozone. So every month you have 25 billion of cash joining the euro currency. More than that, you have the whole savings. The Eurozone is still characterized by large savings compared to other countries. So these savings are looking for investment, safe investment. So as you understand, they are going to buy bonds. The question is now, due to the low level of the yields, considering the long-term forecast we can have according to the ECB, QE, we should consider that the yield curve could be split in two parts. Below 7 years, we think that there is no risk due to the ECB monetary policy. Higher than 7 years, due to the long-term forecast, it's difficult to maintain a bullish view for the whole year on the Eurobonds market. There are two reasons. If you think that the ECB is doing well, having implemented a bazooka QE, at one point it should work. I mean, higher growth expectation, higher inflation rate. So at one point, the yield curve should steep. Second point, of course, we are not alone. I told you that a large part of government bonds have been bought by non-euro investors. So these investors should, at one point, look after the other government bond market in the world. And if we anticipate this year that the Fed should finally hike rates and then push higher the government yields, at one point we should have investors, global investors, especially the Asian investors, selling Eurobonds to switch in favor of a higher return of the US market. So this is the reason why we think on the long maturity we should come back to around 1% of the bond at the end of the year, considering that we have a better return in other areas.
So from what you're saying, Patrick, that suggests an increasing disconnect between the behavior of bonds in the US on one side and Europe on the other side, with yields moving higher in the US. And where do you fit the UK into that pattern? Will they go with the Americans or the Europeans?
We anticipate that the UK should follow the US market based on the economic forecast. UK economy is working well. Of course, the quantitative easing went well, and step by step, the central banks in the Anglo-Saxon countries should take into account the credit activity, which is improving significantly. Compared to the usual comments we read in the economic research, we are more focused on the credit loan activity. Don't forget that we had a crisis due to credit bubble, and the question now: are we going back to another bubble? And our belief is that the credit commercial activity is perhaps too buoyant in the States. And in the UK, coming back, we see everywhere in London the activity better than expected. So at one stage, it's important for central banks to change from a very, very accommodative monetary policy to, I would like to say, a neutral monetary policy soon.